right? You have to know first is how much money you're going to invest on a regular basis in the stocks. So again, don't put more money that you cannot sustain over a period of time. So if it's 5,000, 2,000, put that money away.
Make sure it doesn't hurt you.
Yes, it doesn't hurt you, that it doesn't bother you at all.
Like, for example, if you invest 5,000, doesn't mean you won't be able to eat tomorrow.
Yes, in other words, it's something that you're willing to just set aside and for the long haul. So don't worry about it. So that's one. And then do it regularly.
Okay.
So you have to determine how much money. It's a fixed amount of money I want to put in, invest it regularly. I'll do it monthly, quarterly is what I'll do. And then what you do is that what you do here is that you look for some, you diversify, right? What you do is you do it in regular intervals. So you do it monthly, quarterly is what I said, then you diversify. So that's really how it all works.
When you say over a period of time in your step number 4, how long? I mean, how long will you keep on putting that money away?
From our studies, from my experience, it's even just 10 years. Assume the reason why, for how long, it's the money that you put aside. It's the money that you believe will help support your lifestyle for the rest of your life.
Okay.
Okay? So to support your lifestyle for the rest of your life. So if you put, in the next succeeding slides when we talk about it, if you put 5,000 for the next 10 years, that's 60,000 per year, and the next 10 years 600,000. That's not a lot of money for most people. 600,000 over a period of 10 years is not a lot of money. But you keep it there for another 20 years, 30 years, it can go to as much as, assuming a rate of return of only 8% per year, that will give you about 20 million by the time you retire. And it's only 600,000 that you put, so it's not a lot of money. But the concept is really peso cost averaging. What you're doing is it's something that has been, a lot of these investors have been doing in the past. It's not something that we've invented. It's been time tested. That when prices are high, you buy less shares. When prices are low, you buy more shares. Over time, the average price of your cost will now be much lower than the actual price today.
Wow. Okay, we actually have a texter from a viewer right now by the name of Mitch. Mitch said, hi, good morning. I'm watching right now, and I'd like to mention that I'm 45 years old, and in fact, I've been hesitating to invest in the stock market because even before, it wasn't called investing, it was called playing the stock market. And I'd want to find out exactly from the president himself, how can my money earn if I invest in the stock? If I'm going to be the one to keep on buying stock, how does it earn? I'm sorry, I'd like to ask you personally.
Okay, this is what you do for the person that's asking the question. Okay, it's a very good question. I mean, in the past it was playing, today it's investing. Playing in the past was because of the fact that people were really blind about investing in the stock market because you didn't have access to information or data. Today, you can do actually investing because you have access to information data via the internet. Now, how does one do it? As I said, same process, whether you're 45, 25, or 55. Of course, when you're much older, you have to put more money to be able to get the return you want or the amount you want by the time you retire. So it's too bad you're 45 years old today, so you have to put more money than Marybeth if you started today. Because the rate of return is only a certain amount. The compounding effect will only, you need more time for it to have a full impact. But rest assured, at 45, you will still be better off investing a substantial amount of your savings in the stock market than keeping it in time deposit. Or else, your viewer will have to work for the rest of your life and not be able to retire. Because the money that she puts in time deposit day will only earn 2%, where prices of goods are rising at 5% a year. Therefore, what she puts there would be worth less than what price goods will be when she retires. So you need to put it in an investment that will work much faster than what your banks are giving you today. And that's one way of doing it is in the stock market. This table that you see today, you can see the different people, the nurse, the entrepreneur, the family man. The nurse at 25 starts investing early. She puts 5,000 for every month, and every year at 60,000 for 10 years. And I said again, 10 years, 600,000, and she keeps it there for another 30 years because she's 35 when she stops investing, and she keeps it for another 30 years, the money will be worth 20 million. For a person who's 35, that's the same, will only make, investing 10 years will only make 7,000 when she retires. So time is really
of the essence.
the most valuable asset anybody has in investing in the stock market. But again, this viewer of yours, don't be discouraged. At you're 45, there's still time to make money in the stock market better than what you would if you keep it in time deposit. Okay. So invest your money. Again, allocate a portion of it in stocks that you will not be able to, that you don't need the next 5 years. And I'm assure you, just follow this discipline of investing, you will definitely be able to achieve your goals.
Okay, we have another question by Pat. Pat of Makati wanted to find out, good morning, I'm 22 years old, and you mentioned that the minimum entry for investing in stocks is 5,000. Can it be lower than that?
5,000 is really the minimum, but you can see 5,000 is the amount that you have to put in the stock market, but you can save to 1,600 every month, and when it gets to 5,000 in a quarter, invest it.
Okay, so it can be quarterly. Doesn't have to be every month.
It doesn't have to be every month. It could be quarterly. Just put the money that you can really set aside for the next 5 years or even longer.
Okay, same viewer wanted to ask, may I find out which is more ideal to do, a monthly basis or a quarterly basis?
Ideally, it's monthly. Ideally, it's monthly, but I've done it also quarterly. I told you, Marybeth, in the background, I did it for my driver. My driver, what we did was quarterly. We put money, his retirement money, and today that has grown more than 6 times his value.
Salary.
Yeah, 6 times his value, that amount I invested since 2008.
Wow.
So we did quarterly for my driver because he was retiring, so we had to put money aside. I said, let's put in the stock market. You're retiring. Let's just put it for another 2, it's now 4 years. It's now 6 times his value. And he's quite happy with his investment, and that's the way to do it. So, but ideally, monthly is even better. If you did monthly, you would have even made more.
Okay, we have someone from, what's this? Oh, Pampanga. Pampanga, we have a viewer, Sarah. Sarah wanted to find out, good morning, Sir Dino and Miss Marybeth. I'd like to find out, how can you get your money right away? If you've invested for, like, let's say a year, is it possible to withdraw that money already?
Investing with a time frame of only a year for the person in Pampanga is not ideal. It's really not ideal. Studies have shown that if you invest money in the stock market for just 1 year, there's a 38% chance you will lose money. So there's a great chance of losing money if you just invest for a year. And if you want to do a year, talk to a professional to actually help you invest it. But that's going to be very tough. Investing in the stock market really works if you invest over a long period of time. Look at this chart, this table I just shown you. People have lost money in the stock market because they've invested in the short term. This is a chart that says over the period of 26 years, okay, 26 years, the stock market has been up 18 years out of 26. So 70% of the time, the stock market was up. So if people invested and kept their money for a long period of time, there's a natural tendency that the stock price will go up. But because people think of, just making, investing in the stock market in the short term.
Because they want to earn right away.
Earn right away. That is the biggest mistake. And that's why people lose money. Now, you have to be an expert to actually do that. And it takes a lot of skills, a lot of experience to be able to do trading only for 1 year.
And I think what the audience also and the viewers, for those of you who are watching, you have to understand why investing in stocks a long period of time will actually help you earn more money is because we're looking at the inflation prices. Meaning, for example, if you buy the stocks right now, it may be expensive, but later on in the future, those prices may go up. The prices of goods and services will go higher. So if you buy it as early as now, the returns of your money later on will actually be bigger than how much you're actually paying.
So if you look at it year to year, it's going to be tough. No, but over time, if you add it all up, the returns will be substantial. Here's another chart we'll show you. Here's a table that shows you of the program that we came up in 2008, which we call the Easy Investment Program. We had 5 stocks that we told our clients to buy on what we call the peso cost averaging method. So they put 5,000 every month, and there's a lot of our customers who actually did that. Here's a table. You can be told to buy Ayala Land, BPI, Manila Water, Jollibee, or PLDT. You can see, for those stocks that we put there, 4 out of 5, one would have doubled their money in 2 to 3 years period of time. Because the returns on average would be about 37 or over 30% on average. Now, the only one that didn't do so well was PLDT. You can see PLDT's share price was slightly above what it, at the end of 2002, was only slightly above what it was 4 years ago. Slightly above, I think less than 10% higher or slightly more. But I'm saying, even with that kind of performance of a stock, the return was about 9% per annum.
Wow.
So that's still much better than what you would have
in
made
a time deposit.
in time deposit. See, that's what I'm saying. So that's the reason why you need to diversify you need to be able to start early, and you do it this peso cost averaging, which is, fixed amount, regular intervals over a long period of time. Very simple.
All right, and with that, ladies and gentlemen, don't go away because we'll take a quick break. There's more to come when the workplace returns. Stay tuned.